let's bring in Chris Conway from Australian Stock Report. He's joining us live out of Melbourne. Chris, what do you think of the market's trade today? Because we have been extending losses pretty much since we came online.
Good afternoon, Ingrid. Look, I think this is part of a broader theme. You probably remember me being on the show in recent weeks talking about a downside target of 5,150 to 5,200. And I think, there's a number of factors that are playing into it. First of all, the context. We have seen a wonderful rally on the ASX over the last 7 weeks. It can't keep going ever higher. There's the Brexit concerns, but the thing that I've been looking at most closely is some global manufacturing data. Throughout the rally that we've seen over the last couple of months, the manufacturing data has been stronger, but we've had some reads recently from China, America, and a terrible one from Japan, the worst read in 3 years, I think, suggesting that the global growth picture is starting to become murky once more, and I think that's going to be the thing that will weigh on traders and investors' minds and will come off from these lofty peaks.
Well, we were just talking about commodities as a panel just a few moments ago, talking about basically that those prices did look to be a little solid in terms of where we've seen commodities trade in the last couple of months. What's your take on some of the stock-specific, like Fortescue, for example? Because I know you're currently short this one.
Yeah, currently short Fortescue, and the premise there with iron ore is that nothing has changed on the supply side of the equation with regards to iron ore. 70% of the seaborne market is controlled by Vale, BHP, Rio and FMG, and they haven't reduced their production. And you compare that to something like the oil market, where there has been changes in the supply side dynamics. I was reading some interesting stats just before coming to studio. To maintain the current level of oil production in the US, they need something like 440 rigs drilling at any one time. Currently, there's about 280. So those supply side changes that have affected the oil price are sustainable. So I think oil can continue higher, but conversely, in the iron ore market, we haven't seen those supply side changes, and that market remains in structural oversupply. And it doesn't seem, even to this point, that anything is being done about it. So the basic premise is that iron ore is heading lower, I think, towards the $40 handle. And of course, FMG being so leveraged to the iron ore price, the share price there should come off.
Interesting, because Chris, just stick around, because it's up 4%, but I want to bring in my guest hosts now. Fortescue is the bright spot in the market. It tends to trade sort of in its own direction, and it trades quite. There's a lot of volatility in the Fortescue share price.
That's really because the market's focus has changed with regarding to Fortescue, and if iron ore prices stay higher for longer, which is everything is relative, but if they stay around, let's say, above $45, then Fortescue can pay back its debt quicker. And that is the reason why Fortescue sometimes doesn't follow the other players to the downside or to the upside as well.
Scott, do you have a view?
The positive for Fortescue, and it's been increasing over time over the last 6-12 months, is that it's really getting its cost down quite dramatically. It's gone from being the marginal Australian player to probably giving that position to Roy Hill, Jenna Reinhardt's new business there, and that does change the dynamic somewhat. That being said, it doesn't matter where you are on the cost curve. If the price comes down, your profits get crunched regardless. And so, it resolves some degree of solvency risk or simply existential risk. If it was the fourth player in a three-player market that was going to be in trouble, being that third player behind Rio BHP does give it some breathing room for just literally existence, but doesn't change the impact on its profit. So I've been out of the iron ore space for a very long time, as your viewers will know. I think it's worth staying out of. I wouldn't be in Fortescue. I wouldn't necessarily short it, but I think the pressure is for the downside on prices.
I want to go back to Chris on some US dollar exposed names, because obviously US dollar related names have run pretty hard. You're starting to short some of these. Just talk us through which ones in particular.
You're not quite just yet shorting them, Ingrid. They're definitely on the radar though, and that's simply because they have run so far, so fast on the back of expectations of another Fed rise. If we look at the last Fed rate rise leading up to December last year, the Dixie rallied quite strongly, and then after the Fed raised rates in December, it came off relatively sharply. We're seeing a rise again now on the expectations that the Fed will go sooner rather than later. But again, if the same pattern follows through, the Fed will raise, and then the Dixie will come off, and those US dollar names exposure here in Australia that have done exceptionally well might turn the corner from their lofty peaks as well. So CSL, Cochlear, James Hardie and Westfield are the ones that look a bit too top right.
What do you think of that, Rudy?
As a trading strategy, it makes sense. As an investment strategy, you have to question whether you should follow short-term movements.
Yeah, well, Scott, you've got more of a long-term view, obviously, at the Motley Fool. So would you be shorting any of those stocks in the longer term, or are they just trading opportunities?
I wouldn't be shorting them. I think it's tough to When you're shorting something, you're talking about the business's reality, but also the market's expectations, and I think both of those can change in different directions. If you want to short something, you've got to be very sure about how you expect not only the business to operate, but the market to respond. And in fact, the market's response is much more important because the business can go well, the share price can fall, and vice versa. So you're betting on a future share price. Only in very, very limited circumstances would I absolutely short, but I think they're well worth avoiding.
So Chris, looking forward, really quickly.
Well, it's also that the currency or the Fed is only one element in the thing. I mean, if we end up in a situation where the world gets scared again, then they might seek refuge again in the likes of CSL, and then the whole strategy falls into pieces.
That's a good point. And Chris, I mean, just on that, going forward for markets, obviously you said you're expecting them to continue to weaken. What will be the catalyst for that? I mean, is it for you a commodity story as to why we'll continue to see markets go down from here?
No, I was just saying earlier, I think it's more to do with global manufacturing and that coming back to the centre of traders and investors' minds, and the fact that we've seen some weak data recently and showing that the global growth story is not perhaps that it's all that it's been cracked up to be over the last quarter. We have had some significant improvement. I just don't think it's sustainable. Throw into the mix, as I was saying before, the context of where the market sits right now. We have had a 7-week rally. US markets are within shouting distance of their all-time highs. I don't see what the catalysts are for the markets to break higher. So converse to that, I'm looking at the factors that might see the markets come off, and I think the risks are to the downside. So that's the reason for having some of these stocks in focus. Again, I reiterate that we're not currently short them yet, but I definitely think it's a space worth watching simply because they have run so far, so fast, and that those dynamics can change very, very quickly, and people will have to unwind those positions very quickly if they get it wrong.
All right, Chris Conway, appreciate your insights into the show today. Thank you.
Thanks, guys.
Christopher Conway there from Australian Stock Report.